Okay, good afternoon, everyone. Welcome to this short live revision session for GCSE Business students on finance. My name's Jim, and let's go over to the GCSE Business Team live lounge to see who's in the house today to run the session. Now it's Mike on the left, Pete on the right. Give us a wave, guys, and just to confirm that you're there. You can hear us okay.
Hello.
Mike, over
Hi
to you.
there.
Do you want to just give us as people are saying hello to you in the chat window? Could you just give us a quick overview as to how this session works, particularly for those who've maybe not done one of these before? And then when you're ready, let me know and we'll make a start.
Absolutely. Thanks, Jim, and welcome everybody. We've got a number of different activities this afternoon, and these activities lend themselves really well to participation. So please do involve yourselves. Please do make use of the chat window to have a go and to try and answer some of these questions. To help you with that, if you can grab a calculator or a calculation device of your choosing, then you'll be able to join in and give us some answers. If you do have any questions as we're going along, please pop them in the chat window, and we will do our best to answer them. Shall we make a start, Jim? So we'll start off this afternoon with some MCQs, or multiple choice questions. Question number 1 on the screen: which source of finance would not be suitable for a sole trader to use? Which source of finance would not be suitable for a sole trader to use? A, loan from family and friends. B, overdraft. C, share capital. D, personal savings. If you pop A, B, C or D in the chat box, we'll have a look at the answer in a moment. Good stuff. Lots of answers coming in. So source of finance that would not be suitable for a sole trader. Keyword in the question there, not suitable for a sole trader. And the answer here, as so many of you have picked out, we've got lots of C's, a few B's and a few A's, but share capital is the answer here. And the reason being is that a sole trader is a business owned by one person, 100% of the business owned by one person. Share capital involves selling a share in ownership. So it cannot be a sole trader if it's selling share capital. So C is the correct answer. Well done, those who got it right. MCQ number 2: which of the following is the correct formula to calculate net cash flow in a cash flow forecast? To calculate net cash flow in a cash flow forecast: A, opening balance plus total inflows. B, total outflows minus total inflows. C, total inflows minus total outflows. Or D, total payments minus total receipts. A, B, C or D? Vote now, please. Good stuff. And I think we've got almost universal agreement on this one. Correct answer to this question is C. To calculate net cash flow, it's cash in minus cash out. So inflows minus outflows. Good question there. Test reading of the question. Number 3: which of the following would be drawn on a break-even diagram as a straight horizontal line? Which would be a straight horizontal line on a break-even diagram? Would it be A, total revenue, B, total variable costs, C, total fixed costs, or D, total costs? Great stuff. Really good good to see so many people taking part. Remember, if you don't answer this, you will definitely get it wrong. A, B, C or D, the answer's there on the screen for you. You simply have to decide which one it is. And in this case, a horizontal line on a break-even diagram would be total fixed costs. So C again here. Total fixed costs. Remembering, of course, that fixed costs are costs that don't change with output. Fixed costs don't change with output. So regardless of the output is zero, fixed costs remain the same. If the output is at the firm's maximum, then the fixed costs will stay the same. So it's a horizontal line on the break-even diagram. Well done, those who answered C. Question 4. Which of the following is the correct formula to calculate net profit margin? Which of the following is the correct formula to calculate net profit margin? A, sales revenue divided by net profit multiplied by 100. B, net profit divided by sales revenue. C, net profit divided by sales revenue times 100. Or D, sales revenue divided by net profit. A, B, C, or D? A few more seconds. Great stuff, and there's some more tips and more information coming through in the chat window for you. Seems to be a little less agreement on this one. The correct answer, formula to calculate net profit margin, it's C again. Net profit divided by sales revenue times 100. The net profit margin is net profit as a percentage of sales revenue. So net profit over sales revenue multiplied by 100 to give us that percentage. I think we'll do one more MCQ. And that's going to be question 5. Which of the following is the correct formula to calculate gross profit? Correct formula to calculate gross profit. Is it sales revenue minus total costs? Is it sales revenue minus cost of sales? Is it sales revenue minus expenses? Or is it sales revenue minus overheads minus interest? Have a go. Good. Lots of answers coming in. Not universal agreement, but most people I think are in the right area here. So the correct formula to calculate gross profit. Gross profit is sales revenue minus cost of sales. Cost of sales being production costs or direct costs, those directly associated with production. Sales revenue minus cost of sales will give us gross profit, and then we deduct expenses to get to operating profit and so on. That's the MCQs. I'm going to hand over to Peter for the next activity. Peter.
Thank you very much, Mike. So we've got 3 questions coming up here to test your financial knowledge, and you're going to have 90 seconds to answer all 3. Now, bear in mind, there will be some differences in answers, so let's see what the questions are. Jim, if you could reveal, please. So you've got 90 seconds to answer the following. Can you give me 3 examples of cash outflows, 2 examples of external source of finance, and 1 profitability ratio? It's great to see some answers coming through already in the chat window. Remember, we may have some differences here. Lots of examples of cash outflows. Think about the most common methods, types of expenditure. But that one, what will the business spend money on regularly? External source of finance. Think about whom the business is going to obtain finance from. There's a number of different stakeholder groups they could draw upon here. Right, I think we've come to the end of 90 seconds. So let's just check the answers on screen. Remember, don't worry too much if you had something different to what we have. So let's start by going through 3 examples of cash outflows. Firstly, rent. Usually going to be payable on a monthly basis. Not every business is going to have rent to pay. Some businesses may, of course, pay a mortgage if they own the property. Salaries. Remember to think about the difference between a wage and a salary. A salary is, of course, paid monthly, and it's going to be the total earnings of an employee. So let's assume that someone earns £30,000 a year, and their salary is going to be paid monthly in obviously 12 instalments, whereas a wage is paid usually on a weekly basis based upon how much an individual works. And finally, we've got advertising. Now, just have a think about those different types of cash outflows there. They are going to differ in their extent and their frequency, okay, i.e. how often they are going to be paid. You might only pay an advertising expense once or twice. Next slide, please, Jim. So 2 examples of external sources of finance. We've got a bank loan and a bank overdraft. It's important when we're thinking about these 2 sources of finance to have a think about the purpose of them. In other words, what are they going to be used for and the time scale involved. Of course, we could have also had suppliers, i.e. suppliers are a source of trade credit, which is another external source of finance. And lastly, one profitability ratio that you need to be aware of on your GCSE course is the gross profit margin. Thanks very much, Jim.
Great stuff. Thanks, Peter. So back to me then for a couple of 60-second challenge calculation questions. Just bear in mind here, calculation questions, really important to try and show your workings, try and show the thinking, because even if you get the answer wrong, you might still pick up a mark if your workings are accurate. Here's question 1 of the 60-second challenge. Last year, the fixed costs of a business were £500,000. The variable cost per unit was £1.25, and the business's sale price per unit was £5. It sold 600,000 units, and your task here is to calculate the profit the business generated last year. Answers in the chat window, please. Here's 60 seconds. Thanks for all the answers that you've posted so far. Lots and lots of different answers here, as you'd expect. Just bear in mind here, folks, that a minute to calculate such as this, a minute to answer this question is really ambitious. If you're able to do this inside 60 seconds, you're doing extremely well. In an exam situation, you would probably allow yourself a little bit longer. Let's have a look at the answer. We're trying to calculate the profit for the business from last year. Always a good place to start with these things is with a formula. And in this case, profit is revenue minus total costs. Within that, we need to understand that total costs are fixed costs plus variable costs. And we need to understand that variable costs or total variable costs are calculated by multiplying the variable cost per unit by the number of units sold. So first of all, sales revenue. In this case, the business sold 600,000 units at £5. So the sales revenue was £3 million. Be careful with the zeros, but £3 million sales revenue. The total variable costs, 600,000 units sold multiplied by £1.25. So total variable costs of £750,000. Add those to the fixed costs of £500,000, and we get total costs of £1,250,000. And then it's simply a case of deducting those from the sales revenue we calculated before. So we get the answer of £1,750,000. That's the profit. Well done, all those of you that got that right. Hopefully, if you didn't get that right, you can see the different stages we've gone through to see where maybe you made a mistake. Let's have a look at the second 60-second challenge then. Again, same format, calculation question, and you've guessed it, 1 minute to calculate it. The following year, the business generated a profit of £2,100,000 compared to £1,750,000 in the previous year. Calculate the percentage increase in the profit levels of the business between the 2 years. Percentage increase in the profit levels, and here you go with 60 seconds. Well done. Lots and lots of answers coming in, and many of them are absolutely correct. Well done, all those of you that gave that a go. The answer here is 20%. Now, percentage changes are often an area that creates some confusion and often a point of worry for students. Percentage changes, all we need to do is work out the difference between the new figure and the original figure, in this case 2,100,000 and 1,750,000, and then divide that by the original figure and multiply the answer by 100. So 2,100,000 minus 1,750,000, and then divide that by 1,750,000, and we multiply the answer by 100. The answer is 20%. It's a 20% increase in profit from 1 year to the next. That's the 60-second challenge. Back to you, Peter, for the next activity.
Thank you very much, Mike. So we've got a few true or false questions coming your way now. Again, they assess your understanding of various financial topics. So let's begin with the first one. If the gross profit margin increases on the previous year's figure, the net profit margin will always increase too. Is that true or false? Can I see some answers in the chat window, please? Here, it helps to think about how both of these margins are calculated. Again, quite a few answers coming through. Thanks very much for your input. Really helpful to sort of gauge where we're at with this topic. Right, if we can reveal the answer, please, Jim. Okay, if you put false, well done. If you put true, let's have a think now about why that answer is false. Firstly, gross profit is calculated by taking the business's sales revenue and subtracting the cost of goods sold. Now, to get to the net profit margin, we need to further deduct from that gross profit figure expenses such as wages, rent, advertising or marketing costs. So the difference between the two figures is the key reason as to why that's false, because when we're getting down to the net profit figure, that bottom line figure, we are further deducting additional expenses. Next slide, please, Jim. So profit and cash have the same meanings in business. Is this true or false? Okay, it looks like we're pretty unanimous with our thoughts with this one. And if we reveal the answer, it indeed is false. It's important to remember that profit is usually only calculated on an annual basis, whereas a business wants to know how much cash it's got on a daily basis. Cash is going to be flowing in and out of the business based upon the various expenses that it's incurring. So well done if you selected false for that one. Next true or false question, please. An overdraft is a good source of finance to fund business growth and expansion. So is an overdraft a suitable or a good source of finance if a business wants to fund growth and expansion? A couple of comments coming through already. Brilliant to see. Again, we seem relatively unanimous, maybe a bit of groupthink, but nothing wrong with being influenced by our peers to try and push us in the right direction at times. And then someone steps out, changes direction there. Okay, well, let's reveal the answer, please. This one, of course, is false. Okay, an overdraft is usually only a short-term source of finance. Maybe a business is going to tap into an overdraft if it needs to pay suppliers, usually towards the month end, to enable it to continue to trade the next day. So it's really only a source of finance that the business is going to draw upon in an emergency. Next slide, please, Jim. Right, so what we've got here is another 60-second challenge. However, this time it's no calculations. What we are doing here is testing your understanding of various key terms associated with finance that you've come across so far. So what you need to do is match one of the terms, A, B, C, D, or E, to 1, 2, 3, 4, or 5. Off you go. 60 seconds starting from now. Good, there's a few things starting to come in on the chat. Okay, around about 10 seconds left or so. Okay, let's see how we matched up with that one. How did we get on? So if we can reveal the answers. Break even, of course, here we were matching up the term break even with the formula to calculate break even. Okay, fixed cost divided by selling price per unit. So of course, subtracting the variable cost per unit, otherwise known as contribution on the denominator there. Total costs, well, we get to total costs by adding together total fixed costs and total variable costs. What is the margin of safety? Well, it's the current or the budgeted sales, subtract the business's break-even level of sales. Profit, we arrive at profit by subtracting total costs away from total revenue that's being generated. And if we need to find out total fixed costs, the way that we arrive at that is to take our total cost figure and subtract total variable costs. Thanks very much, Jim.
Thanks, Peter. Really important point there. Just those formulae. If you can learn those, if you can have those in your head, then it makes calculation questions so much easier. Let's look at the red herring exercise then. So we're going to see 4 items, and your task here is to try to select the odd one out. So try and choose which you think is the odd one out and why. Here's our question. Which of the 4 items here is the odd one out? We've got loan, share capital, retained profit, and overdraft. Loan, share capital, retained profit, and overdraft. Decide which one you think is the odd one out, and you can just put a letter in the chat window. If you want to type the whole thing, you can do so, but just a letter will do. Great stuff. Lots of answers, different responses here. The odd one out here is retained profit, and the reason is that the others are all external methods of finance. Retained profit, of course, internal method of finance. Loan, share capital, and overdraft are all external methods of finance. So that means C is the odd one out, the red herring. Here's another one. Which of these is the odd one out? We've got opening balance, margin of safety, closing balance, and inflows. Opening balance, margin of safety, closing balance, and inflows. Which of these is the odd one out? A, B, C, or D? We're torn, I think, here between B and D, looking at the answers. Thank you to everyone who's volunteered a response. The answer here, of course, the odd one out is B, because margin of safety is not an element from a cash flow forecast. Okay, so that is the odd one out. Opening balance, closing balance, and inflows are all taken from a cash flow forecast. Peter, back to you. We seem to have lost Peter there. So what we have on the screen here is...
I'm here, Mike. Just
okay.
Sorry about that. Yeah. So what we've got on screen is two statements. The formula to calculate the average rate of return is average annual profit divided by the cost of the investment. And if a business increases its price, the break-even point would decrease. If we could see some answers in the chat window, that would be great. Is it A, B, C, or D? Okay, there's quite a few B's coming through. Let's reveal the answer, please, Jim. Right, C is the correct answer here. Now, this is one of those questions where you really have to read it carefully. Statement 1 looks correct. However, it's important to remember that the average rate of return for an investment must be expressed as a percentage. Okay, so we're missing that from the first statement. And statement 2 is, of course, true, because if the price of a product increases, then the business needs to sell less items in order to break even. It doesn't need to sell as many units because the break-even point is going to be lower. It's going to decrease. Thanks very much, Mike.
Thanks, Peter. Well, backed by popular demand, one more 60-second challenge calculation for you. I'm not sure if it's the music or the questions that you're enjoying most of all, but have another go or have a go at this one. So a business invests in a new piece of machinery that it intends to keep for 5 years. The average annual profit of the machine is anticipated to be £75,000, and the machine is expected to cost £225,000. Calculate the average rate of return for the machine to 2 decimal places. So average rate of return for the machine to 2 decimal places. 60 seconds. Thanks for all the answers. Seems to be a little bit of confusion on this. Average rate of return for the machine to 2 decimal places. As Peter's just said, we need to work this out as a percentage. Can we see the answer on the screen, please, Jim? Thank you very much. So average rate of return, we're looking for a percentage. So we're going to divide here the average annual profit of £75,000, divide that by the cost of the machine, so 75,000 divided by 225,000, and then we multiply that by 100 to give us a percentage. In this case, 33.33%. Okay, good to see some of you have got that right. If you haven't got that right, that's absolutely okay. Let's just look and see maybe where you went wrong. Okay, so we're dividing the average annual profit by the cost of the machine and multiplying by 100. So that brings our finance recap to a close. If you could give us a like, give us a thumbs up, that would be brilliant. And if you could subscribe, then you'll get notification of the future sessions. And we're back on again next Thursday the 11th. So that the topic we're going to cover there is people. Thursday the 11th for the next session. But give us a like, subscribe, and if there are any topics that you'd like us to cover, any particular areas, please put them in the chat window, and we will do our best. Thank you very much indeed for your involvement this afternoon. Thanks for your contributions, and we'll see you again next time. Peter.
Thank you very much. Bye now.